Gold's price increases often signal underlying economic problems, making it more of a hedge or insurance policy than a traditional investment. A hedge is a strategy used to protect the value of another asset, meaning that the loss on one asset can be offset by an increase in the value of another asset. Gold often acts as a hedge because it is negatively correlated with most fiat currencies, particularly the US dollar. This means that when the US dollar loses purchasing power or decreases in price, the price of gold often increases. Its role as a hedge is crucial in times of economic instability when other assets may lose value, especially financial assets. For instance, during the COVID-19 pandemic and lockdowns, gold prices hit record highs as investors sought a safe haven amidst global economic turmoil. This intrinsic value is why many investors turn to gold during periods of financial uncertainty. Unlike stocks or bonds, gold does not rely on a company's performance or government backing, making it a reliable store of value. Moreover, central banks worldwide hold significant gold reserves, further reinforcing its status as a hedge against economic instability. The reason for this is that gold acts as an asset on the central bank's balance sheet when other assets, such as government bonds or foreign currencies, lose value and become worthless. An increase in the value of gold can offset the losses in other foreign assets. Over the past decade, countries such as Russia, China, and India have been significant buyers of gold, bolstering their reserves as a hedge against economic instability and currency fluctuations. It is also important to note that there are so-called safe haven currencies such as the Japanese yen and the Swiss franc. However, in a currency reset environment, it often becomes a race to the bottom. The US dollar is deliberately devalued to deflate debts away. When this happens, no other country wants its currency to become too strong, as this would make their exports uncompetitive. Therefore, even these safe haven currencies are often devalued through quantitative easing or increasing the money supply, significantly limiting hedging options. By understanding gold's role as a hedge, investors can better appreciate its importance in a diversified portfolio. Intrinsic valuable assets like land, farms, commodities, and precious metals such as gold retain their value regardless of monetary policies affecting fiat currencies. Including gold in your portfolio thus reduces risks and is a wise strategy to consider. A diversified portfolio that includes gold can reduce overall risk and improve long-term returns.